Let's value Paychex to see whether it's a buy or sell. We'll run a DCF model. I'm going to go through lots of high-level information to start, then we're going to pick apart their financial statements. This video is packed with information, so watch the whole thing. Let's get started with the model. This is a large cap company, 51 billion market cap. They're trading at 142 a share, and they have 360 million shares outstanding. Paychex offers payroll processing, payroll tax administration, employee payment services, and compliance services, such as new hire reporting and garnishment processing. The company also provides HR solutions, retirement services, ongoing compliance with government regulations, employee and employer reporting, and of course, electronic funds transfer. They were founded in 1971, 53 years ago, headquartered in Rochester, New York. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Talk about steady Eddie. Their free cash flow is so steady year to year. 1.5 billion in 2022, 1.6 billion in the trailing 12 months. It's so much easier to value a company that has steady financials. When a company has really volatile numbers, it's almost impossible. Look at these margins, 30% up to 33%. About 1/3 of their revenue is converted to free cash flow. That's a really high margin. Above 20 is really good. Net income is the profit or loss on the income statement. It's revenue minus expenses. That grows from 1.4 billion to 1.7 billion. Solid margins once again, 30 to 32%. Net income per share is $4.72. So if you own one share, your piece of the profit is $4.72. Revenue is a sales for the company, and that does go up each year from 4.6 billion to 5.3 billion. Not much of a growth, but at least it's growing, and it's probably close to inflation growth, so they're not detracting. They do pay a nice dividend, closing in on 3%, and they could cover that dividend 1.1 times with their free cash flow. So most of their free cash flow goes back to the shareholders in the form of a dividend. They pay 1.4 billion in annual dividends. The way you calculate that, you take the 2.76% times 51.2 billion, the market cap. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 44 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $39 billion. We divide that by 360 million shares. And we get a calculated stock price of 109. They're trading at 142, so they're trading at a 31% premium. It's a sell according to the model. Their fundamentals look really attractive. I like the business model. They're profitable every year, solid margins, but unfortunately it does seem overvalued. But you do get that dividend payment, so it's not like you're losing out. Even if the stock was flat for a decade, you're still up with the dividend. There are 225 companies in the same industry as Paychex, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 158 million in CapEx, more than the median average. They pay the highest dividend on this list, 2.8%. A lot of companies do not pay a dividend. They generate a lot of free cash flow, 1.6 billion, more than Cadence Design Systems, and Cadence is 50% larger in terms of market cap. It's also more than Shopify, and Shopify is double their market cap, almost exactly double. They rank 12th in market cap, 51 billion. Price to book is a bit high at 13. They're trading at 13 times book value. They have the best PE on this list, 30. That means they're trading at 30 times earnings, which means their market cap is 30 times their net income. They're trading at 32 times free cash flow, about the median. The best is Salesforce at 24. Price of sales looks pretty good at 10, which is a lot better than the average, although the median is 3. Uber is 3.8, that's the best on this list. I guess a lot of companies after 20 have a low price sales. They generate 5.3 billion of revenue, which is more than Cadence. It's also more than the Trade Desk, and the Trade Desk is bigger. So to summarize, I have them trading at a 31% premium, ranking 4 to 10, because it does seem overvalued, but I would definitely buy the stock. I think long term it's a winner. They're number 1 in payroll processing. And I actually got payroll certified a few years ago, just so I could learn the laws and the ins and outs. And I wouldn't even do the payroll for my company, because it's so cheap to pay a company like this. It's like $100 or $200 a month, and you don't have to stress about any changes in tax laws, And then there's also changes in how many hours you have to give employees for breaks, things like that. It's a lot of HR help these companies provide you at a pretty low cost. I did do the payroll my first few years running my company, and it wasn't that hard, but it was just so cheap to hire a payroll company and just plug in the hours people work and not have to worry about calculating anything. Ratio is 4:10. They're not that great. Pretty high price to sales and price to book. PE looks pretty good relative to the median, but still a pretty high PE relative to the market. Financials are good, 5 out of 10. And the only reason it's not higher is because it's kind of steady. It's not really growing much. Revenue up 15% since 2022, free cash flow up 9% since 2022. Healthy, consistent numbers, but not much growth. And as you know, we're in a really high inflation environment, so you would expect a little more growth. They're probably in line with inflation. Actually, free cash flow is falling below inflation because inflation was like 4, 5, maybe even 6% a year or two ago. So 9% over 2.5 years. It's just really maintenance. It's not much growth. Let's go through their recent 10Q. They just reported this. We'll start with their income statement, the 3 months ending 8/31 and the 3 months ending 8/31 of last year. Revenue is on top. Total revenue 1.3 billion, up a little from last year. Let's see if they give a breakdown of the 1.3 billion. I don't see more of a breakdown, but this income statement gives percentages. Service revenue is up 2%, 1.25 billion to 1.28 billion. And they break that down to management solutions, 962 million, PEO and insurance, 319 million. If this said PPO, that would indicate healthcare insurance. PEO is a more comprehensive suite of HR services. It covers a lot of things: payroll, benefits, compliance, workers' comp. Part of their revenue is the interest they earn from the money they hold, and that is up from 33 million to 38 million. They mention it right here. Interest on funds held for clients is up 15% due to higher interest rates. And they invest in pretty safe investments, highly liquid, investment-grade fixed income securities. Total revenue for the quarter is up 3%. Expenses, 772 million, that's also up 3%. So operating income, 550 million, which is up 2% from last year. Taxes, 129 million, a 23% effective tax rate. Net income, 427 million, up 2% from last year. So their EPS is $1.18. Let's go back to their regular income statement so we can see shares outstanding. It's down a little bit, 360.8 million to 360.1 million. Diluted shares is 361.9 million. So that means they issued 1.8 million of securities that are dilutable. I'm trying to find out which securities they have that are dilutable. I know a common one is convertible preferred stock. Let's just search for that term. I can't find it. Maybe just search preferred. The only time preferred is mentioned is when they talk about the capital structure. It includes preferred stock, options, etc. Other securities that dilute are convertible debentures, convertible warrants. Let's look at the balance sheet. Assets 10.5 billion, current assets 7.4 billion. Current liabilities 5.3 billion, so a good current ratio. Current ratio is current assets over current liabilities. You want it to be above 1. Let's look at the current liabilities. 1.5 billion of cash. Accounts receivables 1.1 billion, and they have a lot of funds held for clients, 3.8 billion. They invest the funds held for clients in money market securities, 333 million, asset-backed securities, corporate bonds, 1.4 billion, muni bonds, 1 billion. The funds held for clients is more of a timing thing. You can see a similar amount in the liability section. Client fund obligations, 3.8 billion. So Paychex receives the funds and then pays the employees the following day. Their total assets 10.5 billion, goodwill is 1.9 billion, so it looks like they do a bunch of acquisitions. Their total liabilities 6.6 billion. Their biggest liability, excluding the 3.8 billion of funds held for clients, is the 800 million of long-term debt. So it's not that much debt for the size of the company. Assets 10.5 billion minus liabilities 6.6 billion equals equity 3.9 billion. So they have 3.9 billion of equity. They raised 1.8 billion from selling their business, selling stocks. They profited 2.2 billion from running their business. Now let's look at the statement of cash flows, the third most popular financial statement. Operating cash flow is the first section. You start with net income, 430 million. You add back depreciation, stock-based compensation. Those are non-cash items. You adjust for changes in working capital, and you have 550 million, down from 700 million. They only have 45 million in CapEx, so it's pretty much all profit. In their financing section, they spent $350 million in dividends, $100 million in stock buybacks. Last year, they didn't buy back any stock, so it looks like they had extra cash this year. After they closed their accounting period, the accounting period is 8/31/2024, so as of the close of that day, they have $1.459 million of cash, about $1.5 billion, and you'll see this exact amount on the balance sheet. Remember this number? And it's right here on the balance sheet, cash, $1.5 billion. Let's close out the video by looking at the stock on Simply Wall Street. Its last price, $142.51 billion market cap, up 2% in the past week, up 22% in the past year, which is pretty good, and you get a 3% dividend, so you made 25% on this stock. Simply Wall Street is slightly bullish, $149 a share. They say it's 5% undervalued. 16 analysts priced this stock at $133. They say it's overvalued. They agree with me. I get my future free cash flow projections from Simply Wall Street. I put those projections in my DCF model to calculate the stock price. So you can see 3 analysts predict 2025 free cash flow to be $1.9 billion, 2026 $2.05 billion, then $2.2 billion. Their revenue back in 2013 was $2.4 billion. 7 years later, $4.1 billion. It did come down, it looks like, from COVID to under $4 billion, but now its highest point ever is current, $5.3 billion. That's $5.3 billion of revenue for the trailing 12 months. They were debt-free in 2014 and debt-free in 2018. They added $850 million of debt for an acquisition, and it's still at that level. But it's fine, because when you look at their equity, they have a lot more equity than debt. So you can't just look at one number. Equity is going up each year, it's $3.9 billion. So debt to equity ratio is 21%. And if you look at their cash, you realize they have no problem at all. Cash, $1.5 billion. They're paying their next dividend on 11/26, ex-dividend date 11/6, so you want to own the stock before 11/6 to get that dividend. Here's their yield since 2014. They always paid a good yield. It was over 3% back then. It came down to 2.1% in 2022, but it's coming back up to over 3%. The forecast is still over 3% in 2027. The salary for the CEO in 2018 was $440,000. Now it's $900,000. I wish I got paid $900,000. Total compensation, $7.5 million. Tenure as CEO, 2.8 years. 4 insider sells, 2 buys. The 2 buys were pretty small. The sells were over 70,000 shares. 78% of the company is owned by institutions, 12% by the general public, and 11% by insiders. The biggest shareholder is B. Golisano. Blaze is the founder of the company. You can see he's a multi-billionaire. At one point, he did own the Buffalo Sabres NHL hockey team. The next biggest shareholder is Vanguard, then Capital Research, BlackRock, State Street, Wells. You see a lot of common names: Schwab, Northern Trust, Invesco, Fidelity, yada, yada, yada. Nordea, you don't see this name too often. They're a Swedish investment firm. If you see AB after the name, then it's probably a Swedish company. Their employee count went from 13,000 to 16,500. When employee count goes up, that's an indication the company's growing and doing well. I said indication, it's not a guarantee. And the ticker trades on the Nasdaq, Deutsche Börse, London Stock Exchange, Wiener Börse, Mexican Bolsa, and Sao Paulo Bolsa. If you really want to learn how to dig into financial statements and understand them really, really well, click on this video in the top right corner. Thanks for watching.